Journal entry. A journal entry is a detailed record of a financial transaction, including the date, affected accounts, and debit and credit amounts. It is the first step in the accounting cycle using a double entry system where every transaction has equal debits and credits. These entries are fundamental for maintaining accurate financial records and feeding into the general ledger, which is used to create financial statements like the balance sheet. A journal entry includes date, that is, the date on which the transaction has occurred, accounts, the accounts that were impacted by the transaction, debit and credit amounts. Debit and credit amounts are the monetary values of the transaction recorded with one or more debits and one or more credits. In double entry bookkeeping, the total debits must always equal to the total credits. Description. A brief description of the transaction for clarity and future reference. And finally, a unique reference. A reference number or ID for tracking purpose. Why journal entries are important? It is the foundation of accounting. They are the first step in recording the transactions and form the basis of your accounting system. Accurate financial records. They ensure that your books are balanced and provide accurate data for financial statements. Traceability. They create a chronological and traceable history of all financial activities, which is crucial for audits and internal analysis. Decision making. They provide the data needed to evaluate a company's performance and make informed business decisions. How to record a journal entry. Identify the transaction. Understand what happened financially. Determine the accounts. Pinpoint which accounts are affected. Example, cash, accounts receivable, accounts payable, owner's capital, etc. Apply the rules of debit and credit. To increase an asset, debit the account. To decrease an asset, credit the account. To increase a liability, credit the account. To decrease a liability, debit the account. To increase owner's equity, credit the account. To decrease owner's equity, debit the account. Record the entry, document the date, the accounts involved, the debit and credit amounts, and a brief description. Example 1. Suppose I purchased a car for $30,000. I paid $30,000 in cash. We know that the accounting equation is assets is equal to liabilities plus shareholders' equity. To increase asset, debit the account. To decrease asset, credit the account. In this case, car is an asset, so the asset is increased. So we are debiting $30,000. Cash is an already available asset. That cash asset is being decreased by 30,000. So that cash asset is being decreased. So we are crediting that account by 30,000. So this is how the entry is created. So we have given a short description as purchased car for 30,000. Now let's see another example. Example 2. In this, I'm purchasing the car for $30,000. I don't have $30,000 in cash with me. So what I'm doing is I'm taking a loan of $20,000. I have some $10,000 with me. So I'm paying cash 10,000 and I'm taking a bank loan of 20,000. So in this case, how we are going to make the entry? In this case, the bank loan is a liability. So let's see our equation. To increase the liability, credit account. To decrease liability, debit account. In this case, the bank loan is an increase in liability. So we are going to credit that account by 20,000. So the entry is like this. The car is an asset. The value of the car is debited as $30,000. Cash is an asset. The cash asset is being decreased, so we are crediting the account by 10,000. Bank loan is a liability. The liability is increased, so we are crediting the account by 20,000. Let's see how it works in case of owner's equity. To increase owner's equity, credit the account. To decrease owner's equity, debit the account. When there is revenue, equity is increased and hence credit the account. When there is expense, the equity is decreased and hence debit the account. When the dividend is paid, the equity is decreased and hence debit the account.